Hello and welcome to this fresh new edition of Mutual Fund YouTube Corner. I'm Sonal Bhutra and today we are going to be discussing about sovereign gold bonds. The new tranche has opened and there's a lot of interest in gold investing as well. So whether you should go for sovereign gold bonds or look at something like gold funds or gold ETFs, we have an expert joining us to discuss that in greater detail. Mrin Agarwal, financial educator and director of Finsafe India is joining us now. Mrin, always a pleasure speaking with you. So thank you so much for joining us today as well. And as I said, there's so much interest in gold investing, right? The way prices have risen. How do you look at the recent series of sovereign gold bonds? Do you think one should go ahead and invest in that?
So good afternoon, Sonal. And yes, gold is the flavor of the moment along with equities, especially because we are seeing the tranche one that came out in 2015 has given some great double-digit returns. So I think, without the interest payment, it works out to about 10.87% per annum. And I've seen a lot of queries coming on gold, once this tranche actually matured. I think yes, one can look at sovereign gold bond, but of course it needs to be part of your allocation, right? So if you've already got like 15% or so in gold, then it doesn't make sense just to do it for the heck of it. Ideally, you should be doing it if you do have some amount to still allocate left for gold. And of course, keeping in mind that there is going to be a 8-year lock-in. So you need to be cognizant of that as well. Also, at this point, again, I would just like to caution investors because, again, I see a lot of heightened interest because we've seen this run up in gold, but more importantly, because we've seen this great returns in the first tranche, I see a lot of investors getting into it thinking that they're going to make like 12, 13% returns. So please do not get into it thinking that, because if you look at the average return of gold, it's in the range of about 8 to 9% in the long term.
Okay, that's an interesting take and very honest as well. And that's needed for investors to know whether they should go ahead because, as you said, there's so much excitement. But keeping the recent issue aside, how do you look at sovereign gold bonds versus, say, a gold fund or a gold ETF? Which would you prefer?
All right. So first, let's just understand what are the differences between the three of them. When you look at the gold ETF, it basically tracks the price of gold, and a gold fund basically invests into gold ETF. So it's like a fund of funds essentially, right? Now the sovereign gold bond basically has an 8-year lock-in. It also tracks the price of gold, right? So all three are market linked and all three track the price of gold in some form. The difference really is that SGB has zero cost. Gold ETF and gold funds do have some amount of cost, but the biggest difference is really on the taxation because the returns that you get at the end of 8 years in the SGB are completely tax-free. Whereas the returns that you make on the gold ETF and the gold funds are going to be completely taxable, especially if you're investing after 1st of April 2023, right? Now, I think the choice then really boils down to can I hold it for 8 years or not? Because if you cannot hold the investment for 8 years, then obviously SGB may not be the right choice. Then you'll probably have to go in for gold ETF. So I think, yes, if you have 8-year horizon, then I would say SGB. But if you have a liquidity constraint and you cannot hold for 8 years, then go in for the ETF or the fund of fund, whatever is more convenient to you.
Okay, that is interesting. Mrin, but give us a sense of what you are looking at as gold as an asset class in 2024. If one is looking at creating maybe a fresh portfolio or adding something to their existing portfolio, how much percent should they allocate to gold in any form, be it sovereign gold bonds, be it gold as a physical asset or gold in terms of other mutual funds?
Well, I would say 15% allocation to gold in the overall portfolio. That's what typically most financial planners recommend. But what I normally see is that most Indians already have that in form of physical gold. So if you already have that, then again, I would say do not add on unless, of course, you want to increase the allocation. And of course, when you're adding on, look at the digital form of golds like the ones mentioned out here, simply because physical gold comes with very, very high costs. And of course, you have, holding it and storing it is going to be big issue. I would always say that, gold, we cannot look at like 1 year time frame. I mean, it's always a long-term instrument. So from a longer term instrument sense, it makes sense to get into gold because it typically does beat inflation by about 2% or so. So you can think of plus 2 to 3% over inflation. And hence, of course, yes, it does look good in the long term. Of course, short term could be a little volatile. I mean, it really depends how things pan out next year. And hopefully, with things looking very positive, you're looking at more inflows in equity markets. So that might have some effect. But I think given the run up that we have seen, some amount of correction is always going to be there.
Okay, and that's true for any commodity or asset class like that, right, Mrin? Last question before I let this golden conversation go, Mrin. We've been talking a lot, and this is very prevalent in the newer generation. They like to do that click and invest factor. That works for them. And digital gold is one of them. You can buy it on Google Pay. You can buy it on other fintech platforms as well. How does that differ? Are the storage costs higher? Are the transaction costs higher there? If you can give us a sense of how it would look in terms of the end returns for an investor.
Yes, certainly I do not recommend digital gold because I think you can hold it only for 5 years. That's the first thing. Secondly, I'm not sure if these are 100% regulated, and also is there the auditing of the holding. And while you can buy small lots of gold, the point is that you will have to convert it into physical gold at some point. So there are going to be conversion charges. There is GST and all of that. That is not applicable when you buy SGB or gold ETF, for example. So certainly the transaction costs are higher. There is some bit of holding cost. And again, I'm not sure whether there's any auditing of the holding and how is that really worked out. So I would not really recommend digital gold.
Okay, take that honest opinion. Thank you so much, Mrin, for joining us today and telling us everything about how you can actually allocate gold in your portfolio and what would that look like, say, 2 to 3 years down the line if you're just tracking those prices well. Thanks a lot. It was a pleasure speaking with you.
Thank you.
Okay, with that, we'll take your leave on this edition of Mutual Fund YouTube Corner. But stay tuned. We have more news lined up with respect to mutual fund investing, and we'll get you more.